So let's now continue our discussion of risk and talk about a little bit more complicated version, if you will, of risk analysis, which is referred to as simulation analysis. The more technical, I guess, statistical name for this is Monte Carlo simulation. Essentially, what this is, it's a computerized version of analysis where instead of just changing one or two variables, we change all variables, right? We randomly choose values for any variable that's in the problem. We set up statistical boundaries, though. So let's say we expect unit sales to be on average about 10,000, but have a standard deviation of maybe 3,000. So it will statistically, randomly choose a level of sales with the average and standard deviation. Within that, it will randomly choose within that distribution a value of sales. It will do the same thing with cost of goods sold, with every variable that's in our calculation or in our scenario. It will choose a random number and then calculate net present value. And it will do that thousands of times, right? So it's going to calculate net present value and the internal rate of return thousands of times. So what we get in the end is a probability distribution, right? So we can then calculate from that probability distribution the standard deviations, right? The expected values of net present value or internal rate of return. We can calculate the coefficient of variation. All of those things are created through this fairly complex analysis of a particular project. So what does it tell us, right? So in this case, right, for normal distribution, right, for sales, we get a mean of around 1.25, standard deviations 2. The normal distribution for price is $200, standard deviation of 30. That's the kind of information, the statistical description of each variable that we input. Again, the process, I'm just kind of repeating the process here. We choose a random variable for that. It substitutes those variables and again, calculates net present value. And it does this many, 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 many times. So again, with our mean standard deviation of all of these variables, right, it then calculates the net present value. So the mean net present value is 88,000, standard deviation is 82. If we go down here, the coefficient of variation is 93. What's the probability that net present value is going to be greater than 0? 86.9%. So this is the kind of statistic that we get from these results. So there's a low probability of negative net present value from this particular analysis, right? There's only a 13% chance that it would be negative. So again, applying this thought process now, we're applying this to a project to try to determine what's the chance, right, that it's going to create value or not create value. So what are some advantages here? Obviously, it's going to reflect probability distributions for each input. So we'll be able to more closely provide detail about what we think is going to happen to each one of these variables and incorporate them all at the same time. It's going to show us some different ranges, right? It'll give us an intuitive graph, if you will, of the overall situation with respect to risk. But the challenge is, right, first of all, it's very difficult to specify probability distributions and correlations. One of the things that we may find, and this is very true, especially with things like prices, is that prices do not typically move in a normal distribution, right? So it might be something more like we refer to as a uniform distribution, that really the price, if it changes at all, goes from $1 to $2 or $2 to $3. Those are the only three occurrences, right? So again, we have to understand that certain variables may not be normally distributed, right? And of course, if you put in bad information, you're just going to get out bad information. So in the end, so what do we know? Sensitivity and scenario analysis, all of these, they don't provide a decision rule. All they're helping us to try to understand is whether or not the expected return that we're going to receive is sufficient to compensate for its risk, right? These scenarios we've been talking about, again, these last three techniques of sensitivity, scenarios, has nothing to do with diversification. They only measure standalone risk. And as we've mentioned earlier, standalone risk might not be the best risk, especially if the project is not closely correlated to the stock market and that type of return. We know that for that one, we need a different kind of risk. We need market risk and market beta for that type of analysis. So again, that's the end of the video on risk. I hope you enjoyed it. Talk to you soon.